Here's a secret strategy we can use as property investors to completely recycle our money and effectively buy our property for free. Actually, this investment strategy has been around for decades, and investors have used it on some of the biggest property developments in the UK to get the most out of their capital and extend their wealth even further. Imagine being able to benefit from the growth of a property without having to put any of your own money in to get those returns. Well, in this video, we're going to explain exactly what is it and how you can use it to expand your portfolio to new levels, even if your capital is limited. Hey, it's Phil from Let Property, and we help thousands of landlords every year buy and sell their tenanted property through the sale of specialist buy-to-let property investments. BRRR stands for buy, refurbish, rent, and refinance and repeat. In very simple terms, what does it mean? Well, we're effectively going to buy a property for cheap, add value to that property, rent it out, and then take the new market value, sometimes called the GDV, gross development value, and go back to the bank to ask for more lending on that property. This allows us to refinance, pull out all of the money, and then repeat the process. This means that instead of buying the property, adding value to it, and flipping it to pull all the money back out, we can keep the property and still pull the money out by getting lending from the bank. This way, we can hold on to the property, let it grow in value over the long term, and we still have the capital to move on to the next property. Now, before we go any further, I need to ask you for a quick favour. If you're finding this content valuable and you're serious about growing your property portfolio, take a moment to hit that subscribe button. I pour a lot of time into creating these videos to help investors like you succeed. Honestly, subscribing is the best way to show your support and make sure you don't miss out on future tips and strategies. What you'll notice is that some of the largest developments in the world, including the biggest buildings and skyscrapers, follow this strategy. At a high level, developers create these buildings, add immense value, and then secure large loans against the property's post-construction value to pull out their money and fund the next project. This is now becoming increasingly common for standard buy-to-let investors as well, especially for those looking to build a retirement portfolio. Most opportunities for this style of investment come with old, dilapidated buildings, empty properties, or even tenanted properties that are already producing an income, but allows us to pull all of our money out and get it working for us better. Let me give you an example of a property I did a few years ago in Kingsbridge Drive, Glasgow. I bought it for £75,000 with a buy-to-let mortgage of £56,250. I spent £10,000 on refurbishing the property and I rented it out for £750 per month. My total all-in cost, including deposit, refurbishment and legal fees, was around £32,000. With the property producing a great income and its value increasing due to the improvements, I was able to revalue it at £115,000. The bank provided a 75% loan to value on the new valuation, resulting in a new loan of £86,250. After clearing my previous loan of £56,250, I received the difference of £30,000 in cash. This effectively meant that I only had £2,000 left in the property while it continued to produce £750 in monthly rent. I could then use that £30,000 to repeat the process on another property. If you're intrigued by this strategy and want to get started with high-yielding properties, check out the link in the bio. We've got a hand-picked selection of off-market opportunities waiting for you. Honestly, don't miss out. It's in the description below. It'd be ludicrous not to. When you see people online saying they bought a property for just a few £1,000s, this is likely what they mean. They've leveraged the BRRR strategy to refinance at the high post-renovation value, allowing them to keep their investment minimal while using the bank financing to scale their portfolio. What are the downsides? One thing to consider is the timeline. Refinancing typically takes 6 months due to UK legislation and anti-money laundering policies. You'll need to have the capital available up front before you can pull your money out. Another thing to consider is debt risk. BRRR increases your debt. Back in 2008, banks were offering 110% mortgages, which left many investors underwater when the market crashed. While lending is more regulated today, you should carefully manage your portfolio's debt levels to ensure you're not over-leveraged. That said, the 75% loan-to-value limit in the UK provides a buffer. Even if the market drops, you'll still be able to clear the loan off if you need to sell. I hope this gives you a good understanding of the BRRRR strategy. Many of our clients and investors use it regularly, and it's how I got started in the property investment. If you're new to investing or want to explore whether now is the right time to invest, click here to check out my video on that topic.